I'm Bob Landaas, president of Landaas Company. The last 7 years have been very challenging as a money manager. We've endured the worst financial crisis in 75 years. The last 5 years, we saw the weakest recovery in modern history. So it was with a great sense of relief that I stood up here last year and said that the U.S. economy is the largest it's ever been and that profits have never been higher. And as we indicated in the video, none of you need any kind of reminder. It was cold last winter. I'm normally suspicious, as I said in the interview, that people blame the weather for financial results. I've been at this too long. I've seen the retailers blame poor sales on it's too nice to shop, it's too cold to shop, it's too wet to shop. My attitude is normally, hey, whatever, you didn't produce the numbers. But last winter, it really turned out to be true. The economy shrank over 2%. So we were so thrilled when, not just looking at the gardens to look at the early signs of the crocus coming up or the daffodils poking their heads through the mulch, but the early indications in the springtime that the economy truly had turned the corner. The macro fundamentals, as I have listed here, look pretty good in my opinion, and I'm actually fairly encouraged at what I see for the next couple of years. Industrial production started climbing dramatically this past spring. Retail sales improved. Index of leading economic indicators turned positive. GDP should come in around about 2.2% this year, a little bit below average, but we're still growing. Most forecasts call for growth above 3% next year. That's a pretty good number. Actually, robust manufacturing is what's really turning a lot of earnings upward. New manufacturing orders are now the strongest in 10 years. Car sales, the best in 8 years, best numbers since 2006. And retail sales now are above the long-term average. They've climbed 5% in the trailing 12 months. That's above the 30-year average of 4.5%. So certainly good news on the employment front. We've recovered from all the jobs that we've lost. Rising household debt, this is a big deal. I've got a nice chart coming up on that one. And granted, a lot of the household debt went down because of foreclosures and bankruptcies, but it's now below the 30-year average. So the English translation is simple. The average American household has more disposable income because they have less debt service. Flat to declining commodities prices, pretty unusual at this point in the business cycle. A lot of it is due to the slowdown in China. China slowed dramatically the last couple of years. We've seen oil now at the lowest price in the last 16 months. And then finally on this one, inflation is below 2%. And that's going to be a common theme throughout my presentation this morning for those that have complained that government spending would cause inflation to go way up the last 6 years. It's time for them to give it a rest. It's not going to go up. It can't go up for the various reasons that I'll discuss. Now, the point simply is that it's all about interest rates and earnings. Those are the two things that cause stocks to go up or down. And guys like me are pretty nervous when the Fed starts raising rates. Most of you know that 8 of the last 10 recessions were caused by the Fed raising rates to reduce inflation, and they wind up putting us in recession. So in my opinion, the Fed is nowhere near ready to aggressively raise rates because inflation is barely measurable. So look at the right-hand corner of this chart, upper right-hand corner. It'll show you the dip that the economy took this last winter, pretty significant that we would contract in the middle of a business expansion cycle by over 2%. And as you can see on the far right-hand side of that chart that we did recover from the downturn this past winter, and the economy is the largest it's ever been. If you look on the left-hand side of that chart, you can see that just towards the end of 2007, the U.S. economy hit briefly $15 trillion, and we're on our way to a $16 trillion economy. So the U.S. is producing almost $1 trillion more in goods and services than we produced at the peak of the economy and the market way back in 2007. It's important to recognize that from 1949 to 2000, the U.S. economy grew at 3.6% a year. 3.6% from 1949 to the year 2000. From 2000 till now, the U.S. economy has averaged 1.8%. Right, so half of the post-World War II growth cycle, and it's anticipated to grow above 3%, but 1.8% has been the average since 2000. As indicated earlier, it is about interest rates and earnings. I'll keep drilling into that this morning. You look at, again, the right-hand side of this chart, you see the dip that profits took this past winter, but we've recovered from that. And the simple version of this story is that U.S. profits have never been higher. It is about interest rates and earnings, and we'll drill a little deeper into earnings once I get to the stock section of the program this morning. All right, so here's the employment report that I was referencing earlier. You can see that we lost almost 9 million jobs during the recession, and we've recovered all those now. It took us a long time. We've averaged a little over 200,000 new jobs in the United States this year, and we've gained back all the jobs. So the bad news is that there's still way too many people out of work, about 12 to 13 million. They think there are another 12 to 13 million people that are underemployed. People that are working part-time, rather work full-time and what have you. So we got a long ways to go on that. But the good news clearly is that we've totally regained all of the jobs that we lost during the downturn. So good news, bad news. This is an important chart for a couple reasons. One is Fed policy. Ben Bernanke several years ago said that he was going to target 6.5% unemployment before the Fed started raising rates. So they hit 6.5% unemployment and then moved the goalpost. They figured out that the main reason why the unemployment rate is going down in the United States is people are giving up looking for work. The number of adults 21 to 65 in the workforce is down to the lowest level in 35 years. And it's not just boomers retiring early, it's across all age groups. The workplace participation rate is down to just 63%. Moreover, with labor being so slack, there's no growth in wages adjusted for inflation. That's Janet Yellen's latest target. She wants to see wages grow in excess of 3%. Adjusted for inflation, wages didn't go anywhere the last 12 months. So good news, bad news. Good news is we're creating several 100,000 jobs a month in the United States. Bad news is we have a long ways to go. This is another good news, bad news. Although I'm overall pretty optimistic and upbeat, it's important to reference some of the weaknesses. Household debt service, a lot of it's due to foreclosures and bankruptcies. Some of it's people paying down on the loans. But we're below the 30-year average now. 30-year average is an 11.5%. That's debt service as a percentage of your income. And I already told you the punchline. It's simply that people have more take-home pay to spend discretionary. So that's good news for the economy, and in a large part accounts for the nice 5% increase in retail sales the last 12 months. So this chart's going to take a little bit of an explanation. But I want to give you some background first. I was born in 1952. There were about 3 billion people on the planet. We passed 6 billion people in 1998. We passed 7 billion people 2 years ago. Okay? There was a scholar and a member of the clergy in England in the early 1800s named Thomas Malthus. Some of you might remember from college and school that he was the one responsible for the Malthusian population theory, which in simple terms said that population growth would grow exponentially while food production would grow arithmetically. So in English, what that means is that population growth would be quite a bit faster than our ability to produce food, and Malthus figured out that we'd eventually start starving to death. Fortunately, his theory proved wrong, but for my entire adult life, I've been told that we're living in a world of finite resources. I've been told that we're going to eventually run out of things, and I've been told that the pressure from all this population would cause commodities prices to do this in my adult lifetime. Guess what? Didn't happen. So some of you might have seen the National Geographic issue that came out a year ago, January. According to National Geographic, they think that the world's population is going to level off in the year 2040. We didn't get told that early on, right? Going to level off. What they now know is that we've got an abundance of commodities. So that's the setup to the chart. We've seen commodities prices head south now. This chart starts the beginning of last year. Right? So Malthus was wrong. These concerns about running out of finite resources. I suppose at some point in time that might be true. Only in sub-Saharan Africa are women on average having more than 2 kids. So women need to have more than 2 kids for the population to grow. So it's only in sub-Saharan Africa are you seeing women having, on average, more than 2 children. As the world becomes more affluent, women on average have fewer children. So this speaks volumes relative to inflation. It speaks volumes, in my opinion, relative to the course and interest rates. Because I've been against gold for the 40 years that I've been managing money professionally, it gives me great pleasure to point out what gold has done the last year and a half. As I've tried to indicate over the years, the only gold I own is right in here in one of my molars. So precious metals, including gold, has taken quite a good hit. That's the bottom line. I represent a number of farmers. Boy, that's a tough way to make a living. You know, corn was over $9 a bushel in 2007. It's amazing that we've planted 93 million acres of corn in the United States this year. That's a lot of corn. And some of you may know that corn is not even getting $4 a bushel right now. So the better they do, the more they plant, the worse the story gets. What a tough way to earn a living. So you can see that grains, including corn, is way down since the beginning of last year. Industrial metals, that's the line above it, and then let alone energy. So when you look at the direction of commodities really need to firm up for inflation to start percolating and for the Fed to start raising rates, and we're nowhere near that. Thank you for letting me drag out Malthus. I don't get to talk about the Malthusian population theory that often, but it's important that you recognize the global trends. So this one's one of my favorite charts. You know, I've openly ridiculed an op-ed piece that appeared in the Wall Street Journal in the spring of 2009 that inflation would have to skyrocket because of government spending. I kept telling everybody, hold it. That can't happen if the bankers are going to sit on the money. We've talked about the multiplication effect. If a banker lends me, let's say I'm a home builder, they lend me $2 million to start building houses, and I hire folks to help me build. They get new pickup trucks or used trucks to come to work, and the new homeowners buy carpet and appliances and tile and what have you. We typically multiply that money fourfold. This is another bite at the apple. This talks about the velocity of money, but it simply shows the dramatic effect of deleveraging in the United States since the financial crisis. We're not just low, we're scraping bottom here, folks. Deleveraging has had a profound effect on the markets and the economy, and I've got a number of banker clients here, so I'll take it easy on this one, and just let us say the stingy bankers are sitting on the money. But in any case, money's not circulating. The velocity of money the last 50 years has been 1.85. And as you can see, we're just scraping the bottom here. So as I said in the open, the people that have been screaming that inflation has to go up, it's not only time to give it a rest, but I think it's time for the politicians to try to come up with something else to scare us about, because this one flat out just isn't accurate. So this is the Fed's favorite gauge of inflation. Personal consumption expenditure price index, there's a mouthful. It's buried inside the GDP report that comes out every 90 days, and it's the Fed's favorite gauge. And the Fed's target has been to try to create 2% inflation for the last 6 years. They can't do it. That should speak volumes. If you look at this chart, down in 2009, inflation was barely 1%. And we haven't gotten anywhere near 2% since then, and the projections show that we're going to barely hit 2% in 2 years. If the Fed raises rates to get back to neutral monetary policy, in my opinion, that's going to be one of these. It's going to be insignificant. If the Fed aggressively raises rates to beat down inflation, that's a problem. So the reason why I keep harping on inflation here, and I have some more charts to show you, is that in my opinion, the Fed will eventually, perhaps by the end of next year, start gradually raising the federal funds rate. Normal is a little over 3, they're at 0.25% now. The 10-year Treasury at 2.6 will eventually head to 4, in my opinion, in a couple of years, but nowhere near the Armageddon that some have suggested, because inflation is barely measurable. So in spite of my guarded enthusiasm for the markets and the economy, it's only fair that I point out a couple of things that I'm worried about. We still have a very anemic housing market. Consider that the average credit score in the United States is not enough to qualify the average American for a traditional fixed mortgage. Okay? You want to know where housing's going? There's your answer. Until Americans repair their balance sheets or bankers become delusional again and lend money just because you have a pulse, it's unlikely that housing is going to recover in any meaningful way anytime soon. Housing's a big deal in this country. It accounts indirectly for almost 20% of GDP, and housing is coming back slowly. That's the good news, but the bad news is it's going to take a while yet before Americans repair their balance sheets to get the attention of the bankers. Number two is weaker global growth. Of course, we're the largest economy in the world, and we're growing at a moderate to modest pace, according to the Fed. China's number two, and they're slowing quite a bit. Japan's number three. I like Shinzo Abe, their prime minister. I think he's doing some of the right moves, but they continue to slow. Germany's the fourth largest economy in the world, and they entered contraction in the second quarter. We proved in the 1990s that we can decouple from the rest of the world and still do pretty well, but we're ultimately going to need to see Japan, China, and Germany head back into the right direction for global trade. Cuts in federal spending. So that made the last 11 minutes of the Federal Reserve Board. In the first paragraph on the first page of the Fed minutes, they blamed fiscal policy for restraining economic growth. So within a few months, they'll close the doors on what I think is the least productive Congress in U.S. history. Pretty strange that they really jammed the brakes on spending at a time when government spending was the one thing that really could have turned the economy around. So I'm not trying to get political. I'm just quoting the Fed here. They blame Congress for the lack of spending. Geopolitical risk on the bottom, that's a problem. You know, a couple years ago, I didn't know that I needed to worry about Ukraine. Didn't know I needed to worry about a number of those hotspots. Iraq, I thought we were done there. But the geopolitical risks continue to flare up. And I think it's important to recognize that geopolitical risk rarely weighs on markets for more than 3 or 4 months, because it is ultimately about interest rates and earnings. So with geopolitical risk, it's important to look through the lens of how will that impact earnings or interest rates in the United States. Frankly, we don't do a lot of trading with Ukraine. We don't do a whole lot of trading either with Iraq. And as a result, it's unlikely that they'll have a big impact on interest rates or earnings. When you look at China, you know, if you look on the far right-hand side of that chart, you go, what's the problem? You see their growth above 7%. Well, folks, the problem is that they were above 12% just 5 years ago. And China is kind of between a rock and a hard spot right now. Most experts know that they have to repair their banks, so they're not the least bit transparent with their banks in China. And they know that they have to reform their banking structure. But that's diametrically opposed to the stimulus they need to provide to get their economy turned around. My guess is they'll not have a choice. Later in the year, perhaps in the next year, they will have to provide stimulus. And they've got the one thing that we don't have, which is control of their currency. So they can manipulate their currency, they can provide the stimulus short term, but I think it's clear longer term that financial reform in China will slow their growth. Most of you have pretty small exposure to the emerging markets. Maybe sometime today, drop to your knees, look up, thank your lucky stars, that's the case. Emerging markets have been hammered for the better part of the last 2 years now. And keep in mind one important point. A third of the GDP of the emerging world is directly tied to China. They primarily dig stuff out of the ground, stick it on barges, and ship it to China. When China slows, the emerging world gets pretty sick. So I'm really enthusiastic about the emerging markets, but I think it'll be a while yet before we tiptoe back in. We're getting back to Alan Greenspan's Goldilocks economy, in my opinion. So in 1995, Alan Greenspan made that famous, economy is not too hot that the Fed has to raise rates, not too cold that we have to worry about going back into a downturn, that the economy is just right. International Monetary Fund predicts that global growth will exceed 4% next year. That's a pretty good number. So the good news is that the slow pace of the recovery means that the economic expansion will last longer than might have otherwise, which was clearly the experience that we had in the 1990s, which was one of the largest periods of wealth accumulation our country ever saw. I've got credit Burton Malkai for this one. He wrote a research paper a couple of weeks ago, a Harvard economist, Nobel laureate, that in his sense that the last 5 years we deleveraged and repaired our balance sheets in the United States. And it's just now that we're entering the expansion phase of the business cycle. Pretty interesting concept, because I get asked about every hour of every day, markets at an all-time high, shouldn't we take some money and run? Well, maybe, depending upon your portfolio and your lot in life. But as I'll talk about in a minute with stocks, I think we're just warming up for the main event here. It took a long time for people to pay down their debts and to restructure. It took companies a long time to stabilize. You know, let's face it, it was the worst financial crisis perhaps in our lifetime, and it took a while. And we've known for years that recoveries from financial crises tend to be weak, and we've known for years that recoveries from financial crises take a while. So when I look back on this and say over the last 5 years, that's what they taught me in school, that recoveries take a while from financial crises, and they tend to be somewhat anemic, and frankly, that's exactly what we experienced. So I want to spend a little bit of time going overseas. The United States, to its credit, started to stimulate the economy earlier than many of our trading partners. It's a good thing. So in Europe, Mario Draghi, the head of the European Central Bank, 2 years ago made famous his line that we're going to do whatever it takes to defend the euro. Well, it took Mario and his friends almost 24 months to get around to that. And they announced about a month ago their stimulus program that kind of mirrors the quantitative easing that we've gone through here in the United States. But what's happening now is the U.S. dollar is strengthening primarily because of geopolitical risk. Nothing like a war overseas for money to pour into the USA. There's no place like America during times of uncertainty. But we're getting back to the carry trade. So that started in Japan a number of years ago when they had rock bottom rates. But now what you're seeing is big money is borrowing on the cheap in Europe and buying the 10-year treasury in the United States. So the 10-year German Bund, their 10-year equivalent of treasury is under 1%. The 10-year Japanese bond is under 0.5%. And as I mentioned earlier, the 10-year treasury in the United States is at 2.6%. 2.6 is a bigger number than 0.5 or under 1. So money's migrating to the United States and pushing up the dollar. So it's important to recognize that we were early in the game on stimulus, and Europe and Japan was late to the game. So a change is unlikely in the near term as they institute their financial stimulus. So I mentioned the carry trade, and that has a lot to do with the dollar strengthening now. So I want to spend a couple of minutes talking about the ramifications of a stronger dollar. It's kind of a big deal, and I think it's going to tell you how to invest your money for at least the next couple of years. So a stronger dollar, number one, reduces the cost of commodities. Mentioned that on the slide there, that commodities prices are heading down. And that, of course, lowers inflation, takes the pressure off the Fed. Number two, a stronger dollar will lower the cost of imports, again, helping to lower inflation. Number three, longer-term U.S. interest rates, well, it flattens out the yield curve is what I'm trying to say. If you look at an X and a Y axis, interest rates over time, interest rates tend to go up the longer you lend your money for, right? So a stronger dollar has the effect of flattening the yield curve, keeping interest rates lower in the United States. So again, that takes the pressure off the Fed. We started this year with the 10-year Treasury at 3%. Most of the Wall Street firms were predicting that the 10-year would go to 3.5%. They couldn't have been more wrong. And as I keep saying, the 10-year now is at 2.6%. But a stronger dollar does have a tendency to flatten the yield curve. So for folks that are wondering about interest rates taking off on us, pretty hard with a stronger dollar. And here's the setup. A stronger dollar does reduce the chance that the Fed needs to aggressively raise rates to reduce inflation. So you look at this chart, this is certain currencies against the US dollar. The yen is now at a 6-year low to the US dollar. The euro is at a 14, almost 15-month low to the US dollar. It's getting cheaper to vacation in Europe now. The bottom of this is the Japanese yen, Australian dollar, Canadian dollar, let alone the euro. So you've seen quite a bit of strength with the US dollar against our major trading partners. And that's a good thing short term as the Fed struggles with where inflation's going and how to set monetary policy. So on this chart, you're looking at GDP, broadest measure of goods and services produced in various countries. And I won't spend a lot of time on this chart, but just go to the lower right-hand corner. The bottom line is the Eurozone. The one above it is advanced economies, the developed world. And the one above that is the US. And the point simply is that we started recovering before Europe did. And we totally recovered the GDP that we peaked at in 2007, and that's unique in the world. You can see the slowdown of the emerging world. In Asia, all emerging economies continue to slow, but the world overall, thanks to the United States, is growing. And you can see on the world chart that we're up to almost 4%, which is the number the International Monetary Fund referenced the other day. Now, similar to my comments about commodities, we got to talk about cash. There's an enormous amount of cash sloshing around the world. Now, you look at this chart, it's staggering in my opinion. So look at the top line, emerging and developing Asia. They save on average almost 43% of their national income. That's a big number. So in the Asian financial crisis, 1998 into 99, they had the fear of God put in them. And a lot of those countries had deficits, not anymore. They have surpluses. And you can see on average, they're heading towards saving almost half of their national income. You know what the problem is? There aren't enough places to put that money. You want to know where interest rates are going? Can't go higher. There's plenty of cash around. Businesses are sitting on mountains of cash. You've got a good part of the world saving a good part of their income, and until that slows, interest rates can't go up in any meaningful way. You take a look at the United States, that's an interesting number, and a lot of that is due to corporate America, of course, but the U.S. on average, we're heading towards almost 18% savings rate, and that's not the personal savings rate, this is the national income calculation. So savings is ultimately a good thing. You need cash to fuel the fires. But short term, this abundance of capital is keeping interest rates lower. There's a lot of information on this chart. So I want to take it slow. Look at the emerging economies on the left-hand side of the chart. And on the left-hand side, it gives you global GDP in trillions. On the right-hand side, it's percentages. So if you bear with me for a minute and you look on the left-hand side of the red line, and then you go over and you see the percentage of contribution to GDP, the emerging economies back in 2000 contributed just 20% of global GDP. Now, if you follow that red line up, you can see, and part of these are projections going out to 18, but they're heading towards 40% of global GDP. Okay? Now, if you look at the green line on top, right, and follow it over, of course, it's the inverse. In 2000, the advanced economies accounted for approximately 80% of global GDP. And it's projected now that, again, the inverse, that they're heading towards 60% of global GDP. When I first started as a money manager, way back when, 1975, earnings from overseas accounted for less than 14% of S&P 500 profit. Last year, it hit 61%. It's a big number. Back in 1975, I could care less about consumer confidence numbers and sentiment numbers in Asia. Now I think those numbers are more important than the confidence numbers published here in the United States. So here's a bullet point that I brought up last year. I'm so compelled to bring it up again. International Monetary Fund a year ago estimated that there are about 800 million people in the middle class worldwide. 800 million. They think that number is going to triple between now and 2030. Triple. None of the growth, they think, is going to come from the US, Europe, or Japan. It's all coming from Latin America and from Asia. But we're talking about creating 1.6 billion people in the middle class worldwide in the next 15 years. Folks, that trend is irreversible. That trend is what's going to cause earnings to continue to go up. And it's already started. And the trick, of course, is to make sure that you buy companies, in my opinion, that are primarily domiciled in the United States that do a lot of business in the emerging world. But these are significant trends, irreversible trends, and I think they're going to drive the markets for years and years and years and years to come. I mentioned just a minute ago that the leading question we get at the company by far, Bob, stocks are give or take at record levels. Shouldn't I take some money off the table? So, I need to hit this one head on. First of all, the stock market never dies of old age. It dies of fundamentals. Stocks typically die when PEs are in the upper teens to low 20s. PEs now are just a tad above average. Stock markets die when the Fed's aggressively raising rates, which is why I keep harping on low to no inflation. Stock markets tend to die when investors are chasing just a handful of growth stocks. Think back in 1999, if you weren't in just a few tech stocks, you weren't making any money. Think back in 2007, if you weren't in energy stocks or bank stocks, you weren't making any money. This year, all 10 sectors of the S&P are profitable. So you've got breadth in the market. That's important, not just a couple of investors chasing some growth stock funds. Earnings yield, of course, is the reciprocal of a price-earnings ratio. So you look at earnings, going to be roughly $118 for the S&P. Divide that into roughly $2,000 for the S&P, and you get an earnings yield of just under 6%. 10-year Treasuries at 2.6. Here's what I want you to remember. 5.9 is a bigger number than 2.6. And the spread keeps doing this, okay? As spreads widen, it's bullish for stocks. Reasonable valuations, we're trading for 15.8 times next year's earnings. Average is 15, so we're nowhere near in the nosebleed section. And my best part of the story is that earnings are expected to rise 10 to 11% in each of the next 2 years. So quite a bit above average earnings growth, and we're not overpaying for those earnings. That's the key to understanding this market. Now, of course, the earnings yield versus bond yield can narrow when the 10-year slowly goes up. The spread can narrow if earnings start collapsing, of course. But with 10 to 11% earnings increase for each of the next 2 years, it's not surprising to read that a lot of analysts now are predicting that the S&P, now roughly at 2,000, could head to 2,500 in 2 years. Folks, that's a 12.5% return on your money. Pretty hard to guess short term what the market's going to do, but I love symmetry. Earnings are going up 8% this year. Stocks are up 8% this year. I love how that works. So it's not to suggest that stocks will go up 12.5% each of the next 2 years. There's all sorts of stuff that could screw up that forecast. But the fundamentals, in my opinion, look pretty promising. So here's the earnings yield versus the 10-year Treasury. And you can see with an earnings yield of just under 6% and the 10-year at 2.6, what you want to focus on is the direction of those two lines. They're widening now. And as a result of the forecast of 10 to 11% increase in profits in each of the next 2 years, assuming the 10-year doesn't take off on us, that will significantly widen the spread between S&P earnings and the 10-year Treasury. Going to spend some time talking about profit margins this morning. They're almost at record levels. Here's one of the reasons why. U.S. profits as a percentage of GDP. is the highest that it's been since they started tracking the records. The amount of wages as a percentage of profit is the lowest that it's been since the early 50s. Right? So now, as a percentage of the economy, profits are gigantic. It's all about earnings, folks. So this one puts into perspective the earnings for the S&P. Let's start off on the left-hand side. We hit $107 for S&P earnings, excluding negatives, last year. Forecast range between $117 and $120. We picked Bloomberg's forecast of $119 for S&P earnings. Next year, profits are supposed to go up 11% to $132. Look at the year after next. $148 of earnings for the S&P. I'm reading more and more folks that are predicting that the stock market could go up 20 to 25% over the next 2 years, principally because of the increase in earnings, and a slight expansion of the multiples will get us to 25%. It's important not to overpay. For all the money that I've made myself and for clients over the years, I've tried to focus on getting a bargain on what I buy. I hate overpaying. If you look at the full year forecast for this year, so we're heading towards trailing earning calculations, we're at 16.6 times 2014 numbers, but pretty interesting when you peer into the future and look at 2015 for the full year forecast now. That's the $132 number that I referenced on the prior slide. The market is trading for just under, well, let's just call it 15 times earnings, and that's roughly average. Jumping to the PhD level here for a minute, I think the market's going to do really well just based on earnings growth over the next couple of years, and some of the pros will argue that we should do even better with an expansion of the multiples, in English meaning that the market should be able to support earnings ratios of 17 or more in a low inflation, low interest rate environment. So as I mentioned earlier, profit margins are almost at record highs, almost 10 cents on the dollar. It's a big number. Pretty unusual at this point in the cycle. Let me rephrase that, it's borderline rare. Halfway through the cycle, you're normally paying more for labor. Not this time around. There are plenty of people out of work. Wage growth is almost non-existent. And typically halfway through the cycle, you got to pay more for raw materials because of demand. Not this time around, principally the slowdown in China took care of that. So you're not paying more for labor, you're not paying more for commodities, and as a result, margins are borderline at record levels. 60% of the earnings of the S&P came from outside the United States, as I mentioned. So it's really important to look at overseas economies, not just the U.S. You know, one of my wealthiest clients lives in Manitowoc, and I've told this story a number of times with his permission, that if your frame of reference is Manitowoc, you're despondent. Muro aluminum is gone, the shipbuilding's mostly gone, unemployment in Manitowoc County is in the upper teens. So it's important not to just look at your neighborhood and get a sense of which way the winds are blowing. A big part of the world out there is growing quite a bit faster than we are. One of my concerns with the stock market is small caps. We don't do a lot of work in small caps. I think they're far too aggressive for retirees. I personally don't hold many small caps. I like to get paid for the risk that I take and generally have not. But small caps have had a dismal year. And typically a stronger dollar makes it harder for small caps. High yield spreads are changing. That makes it harder for small caps. So there's a heads up. I think it'll be a while yet before they come back. High yield corporate spreads have widened. I got a nice chart coming up on that. And that's not usually a good sign for the small cap, the low tier of the stock market. So forget the middle column on this chart. Just look at the one on the left and the right. PE is the latest. This is forward priced earnings, and I just want to clarify that. Most people, when they look at PE ratios, they look at trailing earnings. Just tells you what has been, okay? You're driving, looking at the rearview mirror. We're more interested in forward earnings. I want to know where I'm going. I know where I've been. So I tend to look at forward earnings, and the numbers are different. So you've looked at forward earnings, latest is 15.6. Now this is 12-month forward earnings from now. Now you compare that to the 25-year average, Pretty interesting, huh? That's the same number. Look at price to book, give or take the same. Price to cash flow, give or take the same. Price to earnings yield, dead on. Dividend yield, give or take within 10%. So if you compare stock valuation measures currently to the 25-year average, there's no contest there. One of the problems with trailing PEs is that they tend to overstate the market at a time when earnings are going up dramatically, because they're looking back and they're not looking at what's going to happen here, which is why we, of course, focus on forward earnings. So from a valuation standpoint, stocks are maybe a little bit above average, but pretty hard to say that. Earnings growth in the low double digits for the next couple of years, and with valuations being normal and interest rates being low, it's hard not to like stocks. So not to totally beat this point to death, but if you look at the current valuation measures against where they were at various peaks throughout history, gives you an idea that we're nowhere near. Not sure it's fair to compare where we were in 2000 when the internet stocks were real hot and PEs were extremes. But having said that, you know, we literally had a PE on the market of 46 in the peak of March of 2000. Cyclically adjusted PE ratio, some of you might know this one. This is known as the CAPE ratio, made famous by Robert Shiller at Yale. And the CAPE ratios look at 10-year trailing PEs to try to smooth out the bumps. But same point here, we're at roughly 26 for trailing 10-year average PEs. Most extreme, again, in 2000 was at 43, nowhere near. Price to book, again, nowhere near. Price to sales, nowhere near. Q ratio, there's one that's pretty esoteric. It's market capitalization as a percentage of the cost of replacement of assets. And that's quite a bit above, below the extreme, and let alone dividend yield. So on a valuation measure, I think I can make a pretty compelling case that stocks are appropriately priced at this point in time. So we've had a pretty close race this year between value and growth. We've been telling a number of clients recently that if you don't get paid more for being in growth, don't take the extra risk. So I like value stocks. Clients that have been with me a long time know that I favor value stocks. They've been the champion for years. International stock funds are under pressure. Last year, you folks gave up, give or take, 3% on international compared to the domestic stocks. This year's not even close, primarily because of the stronger dollar. When you have to repatriate your earnings back to U.S. dollars, you don't look as good. It takes more currency to buy that dollar. So in a stronger dollar environment, the international funds don't look as good. Technology stocks, in my opinion, finally look good after 10 years of underperformance. So I like tech stocks a lot. Favor the industrials, as I said, new orders for manufacturing, the strongest in 10 years. It's coming back in the basic material stocks. You want to avoid the consumer discretionary and the retailing stocks for all sorts of reasons. And I think that it's clear that value is the place to be. You don't want to abandon growth, but look at this chart. Year to date, large cap value, this is through the end of August now, large value is up 10.3% compared to large growth, which is quite a bit riskier, is up 9.5%. Then go down into the small cap arena, they're barely profitable. And I think I looked at the Russell Small Cap Index yesterday, and it did go negative for the year. So small caps are a rough way to make money, and with the widening spreads between high yield and treasuries, it'll be even harder. So this one we've dragged out now for 3 years in a row, thanks to JP Morgan Chase. They do the calculations. This is pretty easy to explain. What you're looking at is they calculate the 20-year average PE ratio for the various styles of the market, and then they look at current PEs as a percentage of their 20-year averages. And all we're trying to do is bottom fish. I acknowledge my colleague Mark Amateus for his constant reminder that the PEs and the growth stocks were in the nosebleed area in late 99 and early 2000, potentially skewing these numbers, and I agree, he's right. But nevertheless, if you look at the large cap growth, 82% of their 20-year average PE, large cap value just a tad above their 20-year average. You get down into the mid cap value, let alone the small cap value area of the market, they look pretty expensive. Way back in February of 1987, when I started on a local radio station, I would drag out the story of the tortoise versus the hare. And I wound up telling that story for years and years and years. And it's one of my favorite fables, and I think there's an enormous amount of wisdom in that story. And of course, a lot of people thought that fast rabbit would win the race, but that turtle making slow, steady, methodical progress week in, week out, month in, month out, year after year, ultimately won. Typically, new clients come into our firm want to take out a pocket full of money and bet on a fast rabbit. The rabbit didn't win. The turtle won. So if you look at this chart, the punchline's in the lower right-hand corner. Value stocks over the last 30 years have made 11.8% a year. Growth stocks have made 9.7%. Now, folks, get the story straight. Growth stocks do this, and value stocks do this, right? You get a smoother ride for more money. Now, don't mistake this. My most profitable investment ever was a growth stock. Okay, so you can hit the ball out of the park doing growth stocks. But I've often contended that the best deals never leave the law firms where they got incubated. So on the value stocks, of course, it's the Procter & Gamble's, utilities, slow growers, and they've done the best. The green line shows average annual returns, and we're going 30 years on this. So a 30-year look back. Right? And you can see there are occasions when growth stocks, 2009, yeah, of course, in other periods, but over long periods of time, value does better. And there's a reason for that. The definition of a growth stock is that you got to overpay. Right? Simple definition means that it's got above average PE ratio. So by definition, you buy a growth stock or a growth stock fund, you are paying more than normal average market multiples for that stock. By contrast, a value stock, by definition, has a below average PE. So by definition, you're getting a bargain on that stock. And to be fair, it could stay a bargain, it become a better bargain. But the whole idea is very attractive to me to get a bargain on what you buy. And curiously, this is my favorite part of the story, large cap value is not only the most profitable compared to growth, but it's the most conservative area of the stock market. So what's not to like there, right? Large cap value, the most conservative and the most profitable over these rolling 30-year periods. Now, there are periods like in 09 or 1999, maybe it's years that end in 9, maybe that's it, where growth stocks can just do this. And people tend to get antsy and they look at their slow growers and they want to jump on that fast rabbit. But don't lose faith, folks, that large value is my favorite area. And it's interesting that it's done the best of the large caps this year to date. From 2002 to 2007, the U.S. stock market doubled. Most other major markets tripled. The top 4 markets from 2002 to 2007 were the BRIC nations, Brazil, Russia, India, China. Right? From 2007 till now, only 2 developed nations have recovered their equity prices from the peak in 2007, Switzerland and the United States. The BRIC nations, Brazil, Russia, India, China, take 4 of the 5 bottom slots from 2007 till now. The only country that did worse was Spain, for pretty obvious reasons. So it's interesting to see that the emerging world is down, on average, since 2007, 22% from its peak. And we, of course, recovered 5.5 years after the financial crisis. But much of the world has not recovered. This chart, a little bit more current, goes back to the beginning of last year, and you can see that the emerging world, give or take, as flat as a pancake, for the last year and 9 months, whereas the developed markets are up 30%. So the trend is your friend, as they say on the street, and it's clear that U.S. stocks are preferable to international stocks, let alone emerging stocks, for the time being. But at some point in time, the tipping point will get crossed. At some point in time, China will hit the inflection point and start growing again. That'll start growing the emerging markets. That'll start weakening the U.S. dollar as our trade numbers change. And that'll be the opportunity to re-engage assets in the emerging world. So there are a lot of data points on this one. I just want to bring you to the second line, the EPA index, the Europe, Australasia, Far East index. It's got a forward PE of 14. So this is basically everything outside the United States. And it's got a current dividend yield of 3.2. Drop down to the bottom, you got a forward PE in the U.S. of, call it 16, and a dividend yield of under 2%. So you've got dividends that are half again as high overseas, and valuations that are a little bit lower. Normally this would be the point of entry, but because of a stronger dollar and a slowdown in China, you want to wait just a little bit. But at some point in time, the bargains will be pretty obvious. Can't be a seminar unless I drag this one out. So I built almost a $3 billion investment firm on this concept. We studied for years correlation theory. The English translation on this chart, simple to explain. If you have half your money in stocks, half your money in bonds, if you get whacked in stocks, your bonds are going to do this, and it's going to balance the ship. Okay? Fair amount of humility involved in this. But here's why I'm showing you this year. It's obvious to me that interest rates aren't going to take off on us, but it's also obvious to me that if stocks get hit, your bonds are just going to whimper. They're not going to do this anymore. They can't. Yields are too puny. So we're taking more and more clients to 55, 60%, even a tad higher in stocks. And be real careful about the incremental increase. You don't be cavalier about your risk levels. We're trying to overweight value stocks. We're trying to overweight the conservative stocks to keep your betas below 1. I'm not going to abandon what I built my career on. It's important to have safe money in your account. Prior to the financial crisis, it took 23 months for markets to recover back to the prior peak. Financial crisis, as I mentioned, it took 5.5 years to recover. So I love having 7, 8, 9, 10 years of fixed income needs in a client's portfolio to weather the next storm. It'll come, not a matter of if. But I think it's important to recognize which way the winds are blowing, that we're just not going to make a lot of money in bonds anymore. Talked to a big shot bond investor a week ago Monday at our advisory meeting every Monday. We had 30 of us around the table. This guy's named Charles Melcreed out in Boston. And we were talking about the impact to net asset values on bond funds based on where interest rates are going. And, you know, if you have a combination of just average credit quality in your bond portfolio, you know, you're going to be lucky to do 2.5%, maybe 3% on your money. So it beats losing, and we're talking about your safe money here, so you have to have that. But I think it's important to acknowledge that 4 is a bigger number than 2. And there are all sorts of stocks and stock funds that pay 4% or higher dividends. And to the extent that you can handle a little bit more volatility in your portfolio, you're going to want to increase your stock exposure. But back to my favorite chart, you get to the punchline here, and you know, historically, you don't get paid for having a whole lot more than half your money in stock. So traditionally, we have not. So correlation theory studies how assets move relative to one another. And the concept is to introduce as many different types of asset classes as possible into your portfolio that march to different drummers. Now, the problem with correlation theory is that it just looks back, it doesn't look forward. The problem with correlation theory is that it doesn't tell you what's going to happen, it just tells you what has happened in various cycles. So it's interesting to look at the large cap, right, and then go down the column to bonds, and it's got a negative correlation, of course, to the stock market. That's what you want, that if one gets hit, the other is going to pop. So it's important to make sure, as we do at the firm, that your portfolio doesn't act, walk, talk, and look alike, that you have very different types of investments in the portfolio. And the problem, of course, is in the meetings that we conduct, people tend to moan and groan and meow about the underperforming assets, and we say, well, hold it, it's a risk issue. We're concerned with the return of your money, not just the return on your money. So it's important to study asset correlation as we do, and ask your advisor next time you're in the firm to talk about asset correlation and how it pertains to your particular portfolio. It's a wonderful risk reduction technique, and it's kind of like the graduate school answer of not sticking all your eggs in one basket. Own very different types of baskets that react differently to one another in your portfolio. Just a great way to reduce risk. Switching gears, talking about bonds. Been a bumpy couple years in bonds. A year ago, May, Ben Bernanke talked about tapering or reducing bond buying. Bonds got whacked almost 2% that afternoon. Curiously, by the time they got around to tapering this past January, bonds started to rally. It coincided, of course, with the slowdown in China. And it's pretty fair to say at this point in time, with only one more month left of bond buying, that tapering was a non-event. As a trained economist, I love to say, well, folks, the last 6 times something happened, that this, and this happened afterwards, but none of us could talk like that with tapering. We never went through it before. So it's fair to say that tapering is a non-event at this point, that bond yields are quite a bit lower than what they started the year at when they started tapering. So last year was only the 3rd time in 38 calendar years that bonds lost money. Pretty unusual. So the good news is we made it all back. The Barclays Aggregate Bond Index is up almost 5% for the year. I mentioned that the Barclays Bond Index was down 2 last year. So the good news is the rates are stable, that they declined this year, and that tapering turned out to be a non-event. So in bonds, of course, the arch enemy is inflation. What you worry about in the bond market is inflation taking off and creating the possibility of people paying you back with cheaper inflated dollars in the future. Bonds tend not to do well after the 3rd Fed rate increase. But because of low inflation, number one, because of abundant production and labor capacity, I'm not sure how people can raise prices. The consensus forecast currently is for the Fed to start raising rates gradually starting in the middle of next year. Keep in mind, the Fed's been saying that since 2011. Every year they come out and say that, yep, any day now we're going to start raising, and they keep moving the goalpost. 2011, they thought they'd raise by 12. 2012, they thought they'd start raising by 13, and on and on and on. Increases should be gradual because of low inflation. So I'm not a real big fan of high yield at this point in time. Here's why. I like to get paid for the risks I'm taking. I got told way back when that high yield has to have a 500 basis point advantage under the underlying treasury rate for it to be opportunistic. The 10-year average is 5.9. So here's the punchline, folks. When the spreads narrow on high yield, the difference between high yield and the treasury yield, that's the time to be worried. The English translation is you're not being paid to take the risk that you're being asked to take. So in our managed accounts, we've reduced our high yield exposure quite a bit, and high yield spreads make it difficult not only for emerging market stocks, but for small caps as well. It's my responsibility to remind you of this formula. It sounds complicated, it's not. You want to know how your bond is going to perform. You want to multiply the change in interest rate times the duration of your bonds, and that explains price movement. Okay? Now, this is a simplistic view of it because it doesn't take into account the effect of rising interest rates over that time frame. But it's important to stay away from the longer term bonds because you do the math, interest rates go up 1%, you're out 20 years on a bond, you just lost 20% of your money temporarily. So we're staying short term. Most of you have bond durations in the 3, 4, 4.5-year range with us. And it's all about how quickly will rates go up. Either we're going to redo 94 or we're going to redo 04. 1994, Alan Greenspan raised rates 7 times. Nobody saw it coming. The only strategy that made any sense was to get out, go to cash. Just get out. In 04, they kept the overnight rate at 1% from June of 03 to June of 04, and they started raising gradually, incrementally, very transparent. Every 7 weeks when the Open Market Policy Committee met, they raised by 0.25%. They did it for over a year. Everybody knew about it. The point simply is that the best strategy then was to be in the 3, 4-year bond duration range, which is how we think this is all going to play out. Interest rates go up dramatically. You want to jump out and head to CDs and other types of debt instruments, but we don't see that coming, and we're sticking to our guns with, well, that's dramatic. I want you guys falling asleep on me. Reminds me of the hardest speech I ever gave was at the McGovern Park Senior Citizen Center. I did this about 20 years ago. Those of you that know where McGovern Park is. Nobody was younger than 80 in the room. It was in the 90s, and they had these tables in a horseshoe and gigantic box fans underneath the tables. And I lost my voice after about an hour. And I made the mistake of dimming the lights. And I don't know how people, and I have a pretty loud voice, but they redid the lights. They turned the lights on, and everybody's kind of waking up. And I've never been back to McGovern Park since. So in conclusion, a couple of points. One is most investors will need more stocks, fewer bonds, and more cash. Okay? Correlations are rising amongst asset classes, so it's really important to look at your risk levels. Our Morningstar snapshots that we provide routinely for clients, we talk about betas and your risk levels, most intelligent way to look at your portfolio. Investors need to focus on risk reduction techniques for their stocks and bonds. So in conclusion, the U.S. economy is experiencing modest to moderate growth. In my opinion, the macro fundamentals look pretty good. Inflation remains low. It suggests that the business cycle has a ways to go. The stronger dollar will clearly favor U.S. stocks and bonds. Stocks continue to look attractive with only slightly above average valuations and strong earnings growth for the next few years. Interest rates should gradually go up as the Fed focuses on getting back to a more normal monetary policy. And most important, stay balanced with your investments. It truly is one of the best ways to invest. I want to thank everybody for their attendance this morning. I want to thank you for your business and your trust. The program that you just saw will be online the end of next week. All of the charts, the presentation in its entirety will be on the website, so you'll be able to review it. And there'll be a quiz the next time you're in my office. Thank you very much for your attendance, and enjoy the rest of your day.